So, WindForce PLC posts a profit of over 2 billion rupees. But here's the kicker. When you check their bank account, a massive piece of that cash is just gone. We're going to figure out exactly where it went.
All right, just a quick heads up, this is fundamental analysis for educational purposes. It is not financial advice. Okay, so on paper, things look great. WindForce reports a profit before tax of LKR 2.15 billion. But, and this is the kind of thing that makes you lean in a little closer, the actual cash they brought in from their operations, just 770 million. That's a jaw-dropping 1.4 billion rupee gap between profit and cash, a huge red flag we need to investigate. So the billion rupee question, literally, is where did all that cash go? To get to the bottom of this, we've got to start by digging into that profit number itself. First things first, we need to unpack this profit story. Is that 2.15 billion number even a real, honest reflection of how the business is doing day to day? Now, if you just look at the headline number, you'd see profit fell by 3% compared to last year. You might think, okay, not great, but no big deal. The thing is, that number is telling you the wrong story. It's actually super misleading. And here's the reason why. See, last year's profit got a huge artificial boost. We're talking LKR 1.2 billion in one-off gains. This wasn't money from their main business, the stuff they do over and over again. It was a one-time thing. So what happens when you strip away that noise? Well, the real picture comes into focus. The business isn't shrinking at all. In fact, it's growing at a really healthy 18%. That tells us the core operation is actually quite strong. And if we dig a little deeper to see where that 18% growth is coming from, it gets even more interesting. Wind power is still their biggest piece of the pie, for sure. But look at solar. That's the real engine here. Revenue in that segment shot up by a massive 45% as they brought new solar plants into operation. Okay, so let's recap. The profit story is solid. The core business is growing. So that means the answer to our missing cash mystery, it's not in the profit numbers. It has to be hiding somewhere else. And that somewhere else is the balance sheet. And boom, here it is. This chart right here tells us exactly what happened to the cash. Look at trade receivables. That's the money their customers owe them. It more than doubled in 1 year, tying up an extra 1.8 billion rupees. This is it. This is our smoking gun. And just so we're all on the same page, trade receivables is really just a fancy accounting term for sales you've made but haven't collected the cash for yet. So that LKR 1.8 billion, it exists as profit on paper, but it's not actual money in the company's bank account. Not yet, anyway. And the fallout from not collecting that cash is pretty serious. The company's free cash flow went negative by over 500 million rupees. What that means is, after all the money came in and all the bills were paid, including investments in new projects, the business actually ended up burning through cash. Right, so that brings up a really important question. If you're burning through cash, how on earth are you not only staying afloat, but still expanding and building new solar plants? How is that possible? The answer lies right here, in its financial health. The company has a rock-solid balance sheet that's acting like a huge safety net. Just look at these numbers. Its current ratio is fantastic, meaning it has plenty of short-term assets to cover its bills. Its debt is really low, and it can easily cover its interest payments. All this gives it a massive financial cushion to weather this cash flow storm and keep investing. Okay, so let's put it all together. What's the final take on WindForce? What's the complete picture? Really, the best way to think about WindForce is as a growth utility. You've got this amazing growing core business that throws off high-quality recurring earnings. But, and it's a big but, all that potential is being held back, almost choked, because its main customer is taking a very long time to pay its bills, and that's absolutely crushing their cash flow. So, what can we take away from all this? 3 really important lessons. First, you have to look beyond the headline profit number. Always check for one-offs that might be skewing the picture. Second, and this is a big one, revenue isn't real until the cash is actually collected. It's just an IOU. And third, a strong balance sheet is like a get-out-of-jail-free card. It can give a good company the time it needs to fix a temporary problem. By the way, if you're finding this kind of deep dive useful, do me a favor and hit that subscribe button. And that leaves us with the one big question looking forward. That strong balance sheet is a great buffer, yeah, but it's not a bottomless pit of money. So the real risk, the thing to watch, is timing. Exactly how long can a great company keep this up, growing and investing, when the cash from its sales just isn't coming in the door?